everyone, in this video we're continuing our conversation about accounts receivable under the allowance method. You should have already watched a video on estimating bad debts, and now we're talking about write-offs and surprise collections. I'm your instructor, Brandy. In our last video, we talked about how during the year customers purchase goods, and our journal entry would have been debit to accounts receivable with the customer's name and credit to sales revenue. We also went through the process of estimating bad debts under 3 different methods. Under each of the methods, our journal entry was debit to bad debt expense and credit to allowance for doubtful accounts. And this was a contra account to the accounts receivable account. So if we were to look on our balance sheet, we would have our accounts receivable less our allowance for doubtful accounts to give us our net balance in our accounts receivable. Remember that allowance for doubtful accounts is a contra asset account, which means it has a credit balance. The allowance for doubtful accounts was set up when we were estimating our bad debts for the year. Now we're going on to talk about what happens when we write off a customer's account when we know that they are not going to pay. So let's look at an example. In our accounts receivable, we have a balance of $60,000, and we've already set up an allowance for doubtful accounts of $8,160. Included in the accounts receivable is a balance owing from customer Jason Smith for $1,000. In our accounts receivable, we would have our main balance of $60,000, but we'd also have what's called subledgers for each of our customers' accounts receivable account. So in this case, our customer Jason Smith would have a subledger in our accounting records. And this is to show the activity in his individual account, and it's also to keep us informed of who owes us money. If we know that we have $60,000 in accounts receivable outstanding, that doesn't really tell us who we need to call in order to collect that $60,000. It's really important to know who owes us money so we can get payment. So in our case, Jason has an invoice outstanding for $1,000. Let's now expand our example and say that for some reason we know that Jason is not going to pay us, and so we need to write off his account. If we look at our balance sheet before the write-off, we've got $60,000 in accounts receivable, less our allowance for doubtful accounts of $8,160 to give us a net receivable balance of $51,840. Our journal entry to write off Jason's account is going to be debit to allowance for doubtful accounts and credit to accounts receivable with the customer's name for $1,000. And the reason that we're putting the customer's name is so that we can update their subledger. And you can see that this accounts receivable credit is going into the credit balance here in his subledger to write off the account balance. The subledger balance for Jason's accounts receivable is 0 now. We don't expect to collect payment from him. If we go to our balance sheet to see how this looks, we are decreasing our accounts receivable balance by $1,000, but we're just simply taking that out of our allowance for doubtful accounts. So there's actually no change in the net accounts receivable balance. So that's how you write off an account. If for some reason the customer then has enough money to pay you at a later date and they unexpectedly send you a check in the mail, we need to make 2 journal entries. One to reinstate his account and one to collect the payment. So our first journal entry is going to look like this. It's going to be a reversal of our write-off journal entry. Our debit's going to be to accounts receivable with the customer's name for $1,000, and the credit is going to be to the allowance for doubtful accounts. The second journal entry we have to make is to actually collect the payment. So if you look at our subledger, our accounts receivable is first debited for $1,000 and then it's credited when we collect the payment for $1,000, bringing his account back to 0. And that's how you write off and collect accounts under the allowance method. Thanks for watching, everyone.